Many years ago, as a broker, I handled money for high net worth families. Every quarter, and especially during the annual reviews, I would dread the inevitable question.
Did we beat the S&P 500 index?
And by we, they meant did I beat the S&P 500 index? My answer was almost always no, we didn't, because our portfolios are much more diversified than the S&P 500 index. We hold stocks and bonds and international holdings in your portfolio, Mr. Client.
And this better diversifies you against a stock market crash. Blah, blah, blah.
Even though I believe this to be true, my stomach would always turn when I said it. I went to Wall Street to be a great trader and to beat the market. Nevertheless, I continued to reassure my clients that they were better off with maximum diversification.
That means owning a little bit of everything.
And asset allocation.
Ah, the infamous pie chart. This is what the schools teach and what the industry pushes.
Even so, the overall performance of our diversified asset allocated portfolios almost always fell short of the S&P 500 index year after year.
Yeah, and the only years those portfolios would actually shine was about once every decade when the stock market would crash.
Right, and we could finally go to our clients and say, see, that's why we don't hold the S&P 500 index. The problem was that stock market crashes tend to bring everything down, even our diversified portfolios.
Yeah, and being down is still bad news to us investors, no matter how your broker spins it.
To add insult to injury, this performance was often short-lived as the markets would roar back off the bottom and the indexes would start outperforming us again.
Mike, at one time you beat the S&P 500 for a long period of time and thought you could continue beating it, right?
Yeah, and so we launched a couple of actively traded mutual funds using our investment philosophy, and we had some initial success over time.
I remember that day well. That was the day I walked into your office right before the 2008 crash, and you were beating the S&P 500.
Yeah, we had a couple of great years.
But eventually, the S&P 500 had a couple of monster years and obliterated your strategy, right?
Yeah, thanks, Todd. I remember that well. In 2013, the S&P 500 index returned 32%. While our investment strategy struggled to even do half of that. I think we only did 14% that year.
Whoa. Here you had spent thousands of hours building and constructing and trading your best portfolio, only to realize that your clients would have been better off in an S&P 500 index fund for almost no cost.
Exactly. I mean, that was a game changer for me. And it wasn't just me. Warren Buffett and I seem to be on a similar Zen path. In 2013, he also underperformed the S&P 500 index by about 14%.
This was a really big deal because Buffett used to claim that if he couldn't beat the S&P 500, there was no reason for him to get paid or manage money.
Right. It was so important to Buffett that he would lead off every annual report for Berkshire Hathaway with his performance compared to the S&P 500 and specifically focus in on a 5-year rolling period.
So the takeaway for us non-portfolio managers is that Buffett's 5-year returns put him under the S&P 500 index.
Yeah, and how did they report this in the 2013 annual report?
Over the stock market cycles between year ends 2007 and 2013, we overperformed the S&P.
What was that?
Is that a 5-year rolling number?
Let's see. Year end 2007 to year end 2013. That's not a 5-year rolling number.
It's a 6-year rolling number. They changed the rules and added an extra year to keep Buffett's winning streak alive.
Right, and to quote the 2012 annual report, Buffett says, we have never had a 5-year rolling return that underperformed the S&P 500. So, my best guess is that Berkshire added the extra year to give Buffett the win because they didn't want to deal with the blowback that would come from the press reporting that Berkshire's managers couldn't beat the S&P 500 after claiming for years and years and years that this was their benchmark that they never lost to.
Sounds like the lawyers got involved to me. I'm hitting the BS button. You bastages, you dirty little bastages.
Well, what happened next is the real tell. Warren Buffett seemed to go on a personal crusade promoting the S&P 500 index.
I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin.
But he always loved it. There was that $1 million bet thing back in 2007.
Right, but he took it to a whole new level.
He even went as far to say to his heirs to put 90% of his estate into a low-cost S&P 500 index fund.
That's crazy, right? This is one of the top traders of all time.
Rockstar.
And he's telling his heirs to put his estate, when he dies, into an index fund.
And from that time on, Berkshire's annual subsequent reports steered completely away from focusing on the 5-year rolling return versus the S&P 500. Buffett changed.
I mean, and so did I. This was a watershed moment for me. After 20 years of trading and investing for my clients, I realized that index funds were the future of investing and that I had to change everything over to this new model.
If you can't beat them, join them.
Right. My stock trading days were over. It's time for me to admit that index funds were a better investment strategy for investors.
And essentially, Buffett said the same thing, right?
Yes, he's pounded the table on the S&P 500 index versus managers for over a decade. But since 2013, it became personal. That's when he lost the 5-year rolling performance battle against the S&P 500 index for the first time. And then he just
Changed his tune.
became a personal spokesman for the S&P. And essentially, last year he even came out and said it's probably better than he is.
Better than his stock picking. And that's big news for us investors, because if Buffett can't beat the S&P 500, who can?
So we can see why index funds have attracted over $7 trillion in investor assets.
Because investors love them.
They're simple, they're low cost,
And they outperform most managers.
most of the time. The bottom line is that there's something even bigger going on here. We don't believe index funds are just another popular product.
We believe index funds are replacing Wall Street.
The brokers know it, traders know it.
And now it's going mainstream.
The secret is to get yourself a really good S&P 500 index fund.
The old model of stock picking, trading, and trying to beat the market is being replaced by a new internet model driven by index funds.
I love your story, Mike. I can't wait to see what unfolds over the next decade.
We're here to cut through the noise and walk you through this historic transformation on Wall Street.
And help investors make smart decisions on their road to financial freedom.
If I can't beat the 5-year rolling S&P 500 returns, fire me, I don't deserve to get paid. And so then they moved it to a 6-year rolling number, but they didn't tell you it was 6-year. Yeah, I had to flesh it out because I'm like, what a trash.
You bastages, you dirty little bastages.